Meanwhile, Wells Fargo has a message to investors. Use market strength to take risk out of your portfolio. The call coming 2 days before earnings season kicks off. Chris Harvey is the firm's head of equity strategy. Chris, great to have you with us.
Great to be back.
Just as context, we're about, 50 points away from your year-end target at this point?
About that.
So what do you mean by take risk out of your portfolio? Because I feel like risk is in the eye of the beholder at this point.
That's a fair point. So what we're saying is, hey, the trading target, the trading range is it's 4,200 to 4,600. You get up to 4,600 and you can do a couple things. You can just put some cash on the table, or what you can do is start going back into those more traditional defensive sectors, right? Right now, what we want to be is we want to be up the capitalization. We want to be in the Uber caps because we think that's the best risk reward at this point in time. But a lot of those defensives have really rolled over. And now what we're seeing is a situation that's very similar to late 18 and late 21, right before the more defensives really began to outperform. So I think that's where you want to go. So
Uber caps, meaning the magnificent seven.
Twice.
I use air quotes as well because I don't think we should.
And you're doing it on Hump Day.
We should assign a descriptive to a group of
Hump
seven
Day,
stocks.
month and a half before Turkey Day.
Is that those are risky or they're defensive?
No, so those are now seen as the more defensive names, and it's more than the Magnificent Seven. It's the 50 biggest stocks, right? They're trading at a slight premium. You're getting good valuation. You're getting good growth. You have an AI kicker and you have pristine balance sheets. So what's not to like? And what you're seeing from the more defensive ones is rates were going higher, is they just weren't performing. They weren't holding up because of leverage issues. But now I think that creates an opportunity.
Unemployment rate, 3.7. I mean, we get a hot PPI today. Market doesn't care. I don't know about CPI tomorrow.
Yeah.
What makes you think the Fed's going to cut the back half of next year?
I think so.
But right now, I mean, there's no reason to even be thinking about rate cuts, it seems. Now, I understand next year is a long way away, but still, I mean, the environment they find themselves in does not support a rate cut.
No, it doesn't. You don't need a rate cut. What you need is you need rates to stabilize, which is what they're doing. You need the Fed to what got us here is people mismanaged the message. It was the Treasury being much too aggressive in the middle of the summertime. It was the Fed. Now we're beginning to manage the message better. Rates are coming down. We're going into earnings season. Typically what we've seen over the last couple of earnings season is things are not as bad as expected. Things start to rally on that not as bad expected news, and we can move higher. So you don't need a ton. You just need a stabilization of rates is what you're getting, and you need numbers that come out. And sure, we'll see all of that.
So in terms of the trouble on the horizon for next year, what sort of trouble are we talking about, and what sort of downside are we talking about?
Yeah, so Mel, a couple of things. The first thing I'll say is, as we were talking about before, these defensive sectors are telling you that everyone's moved over to one side of the boat. People have taken on too much risk. They've left risk aversion for dead, and that's a key signal. The second thing is there is some sort of lag to monetary policy. We haven't seen that lag, and typically that's not great for the capital markets. And the last thing is people are telling me that we're going to have a great recovery. I just don't see it. How do you have this great recovery without a contraction, without a pullback? There's no pent-up demand, and so I think numbers are too high, and with valuations where they are, you could have a very difficult first half of next year.
All right, Chris, great to see you. Thank you for coming by.
Thank
Chris
you.
Harvey of Wells Fargo.